Hello everyone. Today we are going to discuss about government grant related to agriculture activity and how to account for it under IAS 41. Now, government grants are quite common in agriculture. Governments often provide financial support to farmers either to boost agriculture production, promote sustainability, or sometimes even to control production levels to avoid oversupply in the market. So the big question is, how do we account for these government grants? Well, it depends on how we are measuring the biological assets, either at fair value less cost to sell, which is default rule under IAS 41, or at cost less accumulated depreciation and impairment losses in rare cases. Now, if biological asset is measured at fair value less cost to sell, which will be in the most cases, then IAS 41 breaks down government grants into two main categories: conditional grants and unconditional grants. And the accounting treatment depends on which type of grant you receive. Let's start with conditional grants. Conditional grants are those that come with certain requirements or conditions attached. In simple words, the government says, we will give you the grant, but only if you meet certain conditions. For example, European Union often provides subsidies to farmers, but sometimes these grants are not given to produce. Yes, you heard that right. Instead of producing crops, farmers are paid to limit production to avoid oversupply in the market. Another example could be grants provided to improve irrigation systems or invest in sustainable farming practices. But the farmer can only claim the grant once the conditions are fulfilled, like proving that irrigation system has been installed. So how do we account for these conditional grants? Under IAS 41, conditional grants are recognized as income in the profit and loss statement only when the conditions attached to the grant are fulfilled. For instance, if the government grants $1 million to install solar panels in a farm, the grant will only be recognized as income after the solar panels are installed and verified, not before. Now, let's move to the second type, the unconditional grants. Unconditional grants are exactly what they sound like: grants with no conditions attached. Imagine the government gives farmer a subsidy simply for owning a certain number of cattle or for planting crops in a specific region. There are no additional requirements. The grant is given purely based on the existence of biological asset. In this case, you recognize the grant as income as soon as it becomes receivable, meaning the moment you are eligible to receive it, you record it in your profit and loss statement. For example, if the government offers $5,000 as a subsidy for every 100 cows owned, and you already own 100 cows, you can recognize the grant as income immediately. So far, we have discussed grant related to biological assets measured at fair value less cost to sell, which is the default rule under IAS 41. But what if, in some rare cases, you measure biological assets at cost less accumulated depreciation and impairment losses? This might happen when it is impossible to determine the fair value, especially for non-current biological assets like rare plants or specialized livestock where no active market exists. In such cases, IAS 41 does not apply to the government grant. Instead, you need to follow IAS 20, accounting for government grants and disclosure for government assistance. IAS 20 has slightly different rules for recognizing grants, and we will cover that when we discuss IAS 20 in detail. So let's quickly summarize what we have covered. If biological assets are measured at fair value less cost to sell, conditional grants are recognized as income only when conditions attached to the grants are fulfilled, whereas unconditional grants are recognized as income as soon as the grant becomes receivable with no additional conditions required. And if the biological assets are measured at cost instead of fair value, then you would follow IAS 20, not IAS 41. That's wrap up our discussion on government grants under IAS 41. This is the end of this lecture. Thank you.